We now come to looking at the question of valuing shares, and we are looking at ordinary shares. We've already considered the way that preference shares look more like bonds, and so what we did in a previous week as far as bond pricing and so on, we're not going to go over that because that's what preference shares really are like. Ordinary shares have a lot in common, of course, because you're still taking a dividend. However, we have to make some assumptions when we do our share price valuation, and we have to deal with the realities as far as is comfortable. Remember that the dividends are the value of the shares, not so much the actual historical cost of the capital assets that make up the company. And so we're really looking at the present value of the future dividends to give you the financial value of the shares, of the ordinary shares. This comes as a little bit of a shock, and I can't stress this enough, that we tend to think of shares as shares in the bricks and mortar, as the ownership of the company. So you might own a share in BHP and you might think you own 3 bricks in the head office building or something. You don't. You may notionally have some amorphous share in the company, but really the reason that you own that share is because of the dividends. Okay, so we're going to be looking at how to value those dividends off into the future. The simplest situation for shares is to look at a situation where the dividend is constant over time. Let's just go through the slides so we get a bit of an idea of what's going on here. I think I'll let you read these himself. I want you to look at this equation down here. Okay, notionally, that's what a share is. When we looked at bonds, we said that bonds only have a limited life expectancy. So it might be a 1-year, 5-year, 10-year bond. But after the 10 years, even for a long bond like that, you get your money back. The loan, if you like, is finished. And so you had your interest and your principal, and you can calculate all that. Let's look at what's happening down here with a share. Shares are in the ownership of a legal entity, a legal thing, that's notionally not going to die. We don't think about the way that companies sometimes fail. We think of a company as something unlike a human person. This legal person, the company, doesn't die. And so it's going to be making money until the cows come home, a long, long time in the future. And so we see there's a variation of this annuity, which is taking us off into the future. Now, that's important because that's notionally what's actually happening. If I own shares in Commonwealth Bank or what have you, I can give them to my grandchildren and my great-grandchildren, and they can give them to their great-grandchildren, and the Commonwealth Bank may continue off into the future. And there's some companies that have operated for over a century until companies had more or less begun. Okay, let's look at this equation then. You see, the last term here is not the repayment value in the way that it is for a bond or even a preference share. It's the dividend at time infinity. Okay, that's scary. We don't have to worry about that too much because we're going to find it's actually going to disappear for us, which is very, very nice because we can't evaluate that. But you see, it's being divided by 1 plus n raised to the infinity power, which in itself is infinite. And so 1 over infinity is nothing. So that last term actually doesn't mean anything. Okay. Yeah, I won't go into the mathematical oddities of that last term. The important thing is to see that we've got a dividend, let's say $1, paid every year off into the never never. Okay. And that dollar in a year's time is going to be discounted by 1 plus the discount rate. The dollar in 2 years' time is going to be 1 plus the discount rate squared. The dollar in 3 years' time, 1 plus the discount rate cubed, and so on. And we're familiar with that. That's nothing new. It's the first week of maths, isn't it? That's easy. Okay. But it goes off to infinity. So how do we deal with that? The nice thing about this equation, and I'm not going to go through all of the mathematics of it, is that it actually simplifies into this equation. It might seem like mathematical magic to you, but that's simply the mathematical reality. This equation in real estate is referred to as the capitalization equation. And it's a very important way of turning a series of future cash flows. In the property world, it's rents. In this world, it's dividends or share dividends. Turning those payments into capital. This comes down to a very subtle definition with that we need to be looking at. What is capital? Normally we think of capital as anything valuable, human capital, all sorts of capitals. For an accountant, capital is a capital asset. It's a permanently held thing which has a value because of its usefulness in turning a profit. Here, we're actually going to make something into capital, which is not capital, because the dividend is not capital. It is a payment. It's a revenue. It's a cash flow, if you like. So while this definitional issue is probably not important to you at this moment in time, just starting out on your university careers and so on, it actually is extraordinarily important, because when we talk about capitalizing something, we're making it into something which it wasn't originally. If I put that ISE, or if I was American, IZE, onto the end of the word, it really means turning something into something else. Okay, so this capitalizing or capitalization equation is very important because it turns a dividend into something else. It turns a dividend, which is a series of cash flows, into something else, which is a capital value. It's extraordinarily simple, though. The value, here it's referred to as a price, is simply the dividend, the constant dividend, the dollar off into the future every year for an infinite number of years, divided by your rate of return. Rate of return, how do you get that? You look at what rates of return are common in the market for that sort of an asset. Now that rate of return, when you look at it like that, just over there, I'm thinking of buying a Commonwealth Bank share. What return is NAB shares? What return are people getting on Westpac shares? And you look around and you say, oh, well, people getting Westpac, they're getting 4%. And people who've got NAB have got something else. And so on around it goes. And you say, well, if I'm going to be investing in a bank, that kind of a business, I think I would like 4% too, also. And so that is the yield, a rate of profit, yield, another word for the same thing, which I expect to get. And so I apply that as my expected rate of return. So the yield in the market, as seen by the other yields that are available, becomes my expectation of what I should be getting when I buy my Commonwealth Bank share. Maybe I might see a Commonwealth Bank as a little bit more reliable or a little bit less risky or whatever it's going to be. And so I might adjust the numbers a little bit. But basically, I kind of fit it into the market somewhere. And so that R term, the capitalization rate, is really taken from the yield that other investments are returning. This becomes extraordinarily simple. Let's look at an example of applying that equation. And to here, just to save myself a little tiny bit of typing, I'll just go and put these in. And I'll say my dividend is equal to $1.50. My rate of return is $4.50. Let's see what my value is going to be. And I'm going to be applying this equation, aren't I? So the equation is pretty simple. Okay, I simply write my equation equals the dividend, $1.50, divided by the return, rate of return, the yield, the capitalization rate of 4.5%, $33.33. That should be pretty easy. Okay? Extraordinarily easy, extraordinarily powerful. But it only works if the dividend is really going to be $1.50 off forever. And that's where the wheels come off. And so we need something which will take account of growth. Okay, let's go. There you go, an example, $4.5 for 9% and so on. You can work through these yourself, and I do recommend check them with a financial calculator or even a scientific calculator will do that calculation. That's pretty easy. Put it together on an Excel spreadsheet the way I have. Either of those or both of those whatever you do, just do it until you're really, really comfortable with it, because that's what's going to get you through your professional career and the exam and the assignments and all that sort of stuff. Okay, let's go now to the situation where we've got growth. Okay, because the $1.50 in our dynamic world isn't going to stay there, is it? If I get $1.50 for my share today, I expect in a couple of years' time it'll probably go up to $2 or something, I hope. Certainly in the real estate world, if you got a rent of, I don't know, $100 a week sort of 20 years ago, you'd expect that the rent would have gone up by now. So we've got to put growth into our understanding. Okay, read through the slides because they really give you the background. I find this kind of a nice diagram in the slides, but realistically, I don't know if it is that rivetingly important for you. This is the part that I want you to look at. Here's the equation. You'll see it's like the equation that we had before, a little tiny bit more complex, if you like, because now still got the dividend on the top line, but here instead of having just the rate of return, the discount rate on the bottom line, we've got R minus G, and G is the rate of growth. Let's put up an example of that now. And so we'll come over and on our Excel spreadsheet, we'll just put in a new situation. We're going to have the data now is the dividend and the rate of return, the rate of return 4%, still the same numbers, you see. But here, what I'm saying is that it's going to be growing at 3% every year. That might be inflation. It might be the fact that the company is expanding. It might be opening up an overseas branch or something, or it might be going interstate or whatever it's going to be doing. It's going to be growing. So here, what we'll do is work out the value now using this new equation. It's still going to be the dividend. This time it's going to be divided by, I'm going to open brackets, I'm going to say 4.5%, that cell, minus the 3%, that cell, I'll do it by cells, and bingo. Oh, isn't that lovely? What that's telling us is that I've now got a 3%, sorry, $100 of value in my ordinary share, whereas before I only had 33%. Where did the other $66 come from? It came from the fact that the share is expected to grow over time. And this is one of the peculiar things about what happens here. Even though there is a subtraction in here, the growth is being subtracted, the fact that the denominator is getting smaller means that the overall expression, the D over R minus G, actually gets bigger. And I'll show you what happens there. Let's take that up to 4%. Whoa, look at that. It's made the security even bigger. Now, you expect that, don't you? Because the more growth that you've got in something, especially, let's say it's some company just starting out with really shiny prospects and all the rest of it, so you expect it to be going really, really well, you expect to pay more for that. And that's what we see through here. And this also illustrates the way that when you write these equations in Excel, they're dynamic. So I can play now with these different values and look at what's happening. Okay, let's take the value, let's say COVID starts, and so the growth goes, well, let's go down to 0.05, 0.5%. Okay, and 0.5%, the value is now getting closer to the no growth model, so it's down in the $30 mark. If we take that up to 1%, you can see it kind of growing. And so you can play with this. And playing with these models and putting different values in is a tremendous way of learning. So do that, okay? Write yourself a little model on Excel. It's really easy. Copy what I've done here. And then play with the data. And so you get a real feel for it. And that'll make it really easy for it to become like second nature, like riding a bicycle, which is really what I want for you guys. Read through the examples. There's a worked example here with other data. So work through those. You've got my model here. You've got the example here. Make sure they both work. Check them with your calculator. Put them on Excel. Preferably do 2 calculations. And so you rivet at home, and then play with the numbers yourself so that you're really totally happy with it. Okay. And so we're just going to work through a lot of slides that are intended to get you thinking about pretty much the same idea. This constant growth model is pretty important. Okay, there's a little tweak here that we want to look at, and that is the fact that when you work out the price at some time, it's got to do with the dividend in the following period if we've got a growth situation. What do I mean by that? Well, up here I'm saying that the dividend, I've got the data for the dividend, maybe last year's dividend was $1.50. Okay, fine. And it's going to be $1.50 next year and the year after, So, who cares what, it's just $1.50. Not a big deal. Okay. Here, though, the historical data, what dividend is paid on common bank shares? Well, I don't think they'd be $1.50, but let's imagine they were. If it was that value last year and the dividends are growing at, in this case, 1%, what's the value of the dividend in the coming year? Because that's the one you need to use for your valuation model. So our calculation here needs a little bit more tweaking. Okay, what we need to say is that our price at time t, our value at time t, is equal to the dividend for the next period. Now timing is starting to get really important, okay? Because if this was D, let's say D0, and I'll put that in with a subscript to be very precise. Subscript. Does look fancy, doesn't it? Now my valuation is going to be a little bit more tweaked. Come down here. What I'm going to do is take that, put it in there, but I want to turn the 0 into a 1. Okay. And so what I'm going to say here is that, what I'm going to calculate, is what happens to next year's dividend. What's next year's dividend? I've got last year's dividend is $1.50. What's this year's dividend? Well, it's growing at 1%, isn't it? That should be pretty easy. Pretty obviously, really. $1.50 last year's times, open brackets, 1 plus I, in this case it's the growth, n is equal to 1, so we don't worry about putting an exponent in. Okay, this 1 plus I to the n, 1 plus I to the n. That expression is so important for so many financial calculations. Here the I is the growth. And the I can be the growth, the inflation rate, the rate of all sorts of rates of change. Okay, 1 plus I to the n. Pretty much the universal solution to most of your financial calculation questions. Okay, what's this saying? This is saying that next year's dividend is likely to be $1.52. And therefore, when I get to the valuation here, I shouldn't be taking the value of $1.50 as my dividend. I should be using the estimate of next year's dividend, $1.43. Another way of getting that same answer, and I'll write the equation here, is to say if I've got the historical dividend and I've got the rate of growth and I've got the required rate of return, the numerator should be the coming dividend, which I have to calculate. If I've got last year's dividend, to get to the coming year's dividend, I multiply by 1 plus growth, 1 plus G. That's what I'm going to do here. So I'm going to write $1.50 times, open brackets, 1 plus the growth rate. That gives me the numerator. I'm going to divide by, open brackets, the rate of return, discount rate, minus rate of growth, close brackets to complete my denominator, hit my return, and bingo, I should have the same number. And by happy coincidence, I do. So there are two different ways of working out the same number. Okay, here I've done it in 2 steps with 2 slightly simpler equations. Here I've rolled all those up into one equation. You can go back to the notes, the PowerPoints, and make sense of what's going on there. Same dynamics though. If the growth is increasing, let's make that 2%. The thing is getting more valuable. Turn that growth to 3% and so on. $103, that's marvelous. Okay, let's take it back to 1.5%. In fact, we might take it, well, who knows, 0.5%. Excel, when you put in 0.5 and it's in format of percentages, if you put in a decimal point, it assumes that you're putting it in as a normal decimal. So if you're trying to put in fractions of a percent, you've got to remember to put in a couple of decimal point and then a couple of zeros before you go. So here I want to put in 0.5%. So it goes in as that number, 0.005, 5 thousandths, or 0.5%. Hit enter there. That is formatted into the percentage format, and out it comes as my numbers. Okay, that's constant growth. Okay, that's often how businesses operate, and it's often as far as an analyst, somebody trying to work out the value of the share, or the notional value of the share, can get to, especially for a mature company, because mature companies don't do major changes generally. Okay, if you have some crisis, global financial crisis, coronavirus crisis, maybe those things will change, maybe invited by a foreign body or the Martians or something. But in the absence of those really unusual and out-of-the-box things, a mature company will tend to grow, or intend to expect to grow, at a constant rate. That's not the case for new companies, though. And so while this is a very nice and fairly complete model, or equation, if you like, for valuing company shares, it doesn't value all shares, because immature companies, new companies, startups, if you like, are actually following a different kind of pattern. We're eventually going to be looking more closely at the way that startups work and their financing, all the rest of it. But here we're just going to be looking at the calculation side of it. Okay, so I've got constant growth under control. We've played with that. We're going to come down with what we're going to call supernormal growth. Now, this is the situation of a new company, because often when a company starts out, they've got to establish their markets, they've got to establish their routine, they've got to sort of bed in their production capacity and their sales and their management and all the rest of it. And so what that means is in the first year, they're probably not going to make a lot of money. Maybe the following year, they might get their act sorted out so they make a lot more. In the next few years, they're going to be getting their supply chain worked out. They're going to be working out their sales routine and marketing, and they're going to be expanding their markets, and all sorts of good things are going to be happening. So they're going to have fairly strong growth, like really strong growth, as they get themselves established on the map. However, once the company has reached a certain point, that growth, that strong growth, which characterizes a new company, a startup, use the popular terminology now, it then levels out, because the company is no longer a startup. It's no longer making its mark on the world. It's now settling into being just a normal, reliable company that everyone knows and is familiar with, and it's pretty much got its market share sorted out, and it's probably not going to do very much. So you end up with this 2-stage trajectory of a new company. Strong growth, super normal growth in the first stage of the company getting started, and then normal growth, the expected long-term growth, which is a lot more modest off into the future. How do we value that? Why is this important? Well, it is a bit of a tweaky kind of thing, because it does put a bit more complication into the mathematics, but it's really important because startups are an important part of the investment world. Okay, pretty much explain what's on this first slide. Now we're going to look at our equation. Now, at first sight, this equation looks pretty much the same as the ones before. except you've got, instead of the dividend at infinity, you've got these actually two terms. You're only going out to a time t, and at time t, from then on, you've got something like a constant performance, maybe constant growth performance. And so the way you work this out is that you work it out in an expectation of a one growth rate in the early part of the share's life, the company's life, and then at some point, time t, maybe 3 years, 5 years, 10 years down the track, the dividend is going to set out something sort of more modest. It's reached a certain level, and then from then on it's going to be more modest. And the way we take care of the tail, if you like, of the company's value is by working out its price using the simple model that we've just done from then onwards. So there are these two parts. We work out the price when it starts to act soberly like a nice mature company, which we've already done the modelling for. But up until that point, we have to use this period by period approach, which is a little bit more tricky, a little bit more complicated, a bit more fiddly. Not hard, by the way. It's just fiddly. Note that the denominator here is my favourite expression, 1 plus I to the n. In this case, 1 plus the discount rate to the n. And we work that out period by period. Okay. Let's look at how that works. Okay. This here will stump people, but let's work through an example. I'll work through an example, and then hopefully that will make it really straightforward for you to then read through the rest of the slides. Let's look at a situation where we expect, and I'm going to borrow some of this mathematics just to make it a little bit easier. I'm going to say new company. Right, okay. I'm going to say I'm expecting my dividend, let's say, to be only 50 cents in the initially, right? And I expect my growth down here to be, let's say, 4%. And my yield, my cap rate, my discount rate to be 4.5%. Okay, I'm going to say this is going to be for the first, let's say, 4 years. And then we're going to have growth. And we'll call this G2. Here we'll call it G1. And I might even do the fancy subscripts and stuff to it. Subscript. Okay. Thereafter. And we'll say that's going to be nice, sober growth rate of 2% thereafter. Put that in there and we'll make it 2%. Okay. Growth 4% for the first 4 years, and then it's going to be a growth of 2% thereafter. Let's look at the dividends. I'm going to steal a little bit of text here. And I'm going to work out the dividends year by year. This is going to be the first one that I'm really interested in terms of helping to contribute to the share value, because D0 is my historical dividend, maybe what the people in the back room have worked out as the value. I'll just bring down the data here. So we said D0, last year's dividend, or at least the computed dividend for time naught, is 50 cents. Now, I'm not really going to be, that's come and gone, or it might only be out of a business plan or something. What I need to do is work out what D1 equals. And to do that, I have to take last year's dividend and I have to multiply it by 1 plus growth. 1 plus the growth rate for the first 4 years. I will absolute that, so F4, function F4 if you're using a laptop and Windows, and that will give me the new dividend, the dividend at D1, and that will continue year by year. And so by the time you get up to the 4th year into the future, we're getting 58 cents rather than the 52 cents that we had at the beginning. Okay, so that's just the way all that works. If I was to sell the share at the end of D4, I would be working out its value at D5. And so I'm going to work out D5 here as well. I'm going to work that out just simply by filling this down a bit. Now, I'm not actually going to be owning the property. I'm assuming, let's imagine, you see, I own this for 4 years, and I'm the kind of venture capital kind of person that likes the risk and the excitement of investing in new companies while they're going through this growth phase. And so I think to myself, while it's a new company, I will own it, but I'm going to sell it once it plateaus, once it gets back into the stodgy, ordinary kind of share kind of world. Okay, so I intended to sell it when that growth slows down, which is going to be at the end of year 4. Now, when we do year 5, I have to do a little bit of adjustment here, because remember we said, I'm going to ask you the question, what is the growth between years 4 and 5, right? Well, depending on what your intelligence says, what's happening here is to go from the dividend in year 4, the end of year 4, we get a dividend check of 58 cents, but I'm not going to have the 4% growth in year 5, am I? I'm only going to have a 2% growth, because the company now has gone out of that super normal dividend, growth level. It's now in normal growth. And so I have to adjust this equation so it's not growing at the supernormal rate, the early rate. It's only growing at the faster, the more sober rate, G2. Okay. So I've got my equation there. I'll just check that it looks right. That's growing at the right rate, so that's happy. Back here, I'm growing at the 4%, so that's all fine. Okay. What I'll do, I'll just put this number up. I'll make that $5 rather than 50 cents, because that will illustrate the way that this is not linear. It looks linear when you're only using small numbers because of the rounding effect. And here we can see it, we're going up by 21 cents. 21 cents. Here we're going up by a bit more. But here we're not going up by the numbers in the 20s. We're only going up by a number, was it about 12 cents? Okay, so it just gives us a better conceptualization of what's going on. Okay, I'm going to grey this out because I'm not actually going to own the company at this point. Okay, so I'm just going to make that, let's take that down to a grey. My formatting does not seem to want it to work. Okay, won't worry about that. I'm not doing an Excel session. Okay. But I will just take this out of the way a little bit because I don't want it to be getting in the way of our calculations here. Let's go back and look at the equation that we've given here. Okay, we've worked out the dividends, and we'll work them out up to the dividend I'm going to receive in year 4, and I'm going to work out the price at the end of year 4. And remember, we're going to calculate that price on the basis of the coming dividend. So that's where we need the $5.97 from. Okay. I'm going to be discounting each one of these dividends by 1 plus r raised to the nth power. And so the discount effect is going to be, now here I'll write it out as a discount factor, which is going to be 1 over 1 plus I to the n equals 1 over, open brackets, 1 equals okay, I'm going to work out the discount factor, which is going to be 1 over, open brackets, 1 plus the discount rate, which is R. I'm going to hold that, so I'm going to F for it. I'll put in the equation raised to the 1 power, and I'm going to fill that down here, and I'm going to raise it to the 2 power, and I'll just raise it again. Now here I want it to the 3rd power. I'm just doing a little bit of copying and pasting here, being a lazy bloke as I am, but you'll notice I'm just changing equations. The equation fills down exactly the same there, but I actually want to change this last number to 4 here. So that gives me the discount factors. I'll call those DF for discount factors. I'll format them up so they look nice. Okay, I'll work out my PVs. And the present value is the $5.20. Now I'm going to multiply by this number here, which is really dividing, remember, because the number here is already in a reciprocal form. Okay, so the $5.20 I have to wait 12 months for is only really worth $4.98 today. And I'll fill those down. And if I sum those, it means that the share appears to be worth $19.76 if the company was to disappear at the end of the 4th year. Okay, but the company's not going to disappear at the end of the 4th year. I'm going to sell it. Okay, so I want to work out what value I'm going to get for it at that point in time. Okay, so here I'll just move that over there as well, and I'll call this. Just again copy that down, and I'll have the value here is P4. I don't want the superscripts, I'll take that out, subscript, sorry. Okay, so I've got the dividend in year 4, that's got a present value of $4.90. I've got the dividend in year 5 if I was to earn it, but I'm not going to, of $5.97. But I'm going to use this future dividend to work out the value of the share at this point in time, which is 4 years' time. I'm going to use, since these are both the same time, they're going to both use the same discount rate. So I've just copied here, I've just copied the value across in, so that's all easy. But I want to work out what the price is going to be. I have to put that in here. The price is going to follow the constant growth equation. It's going to be the dividend in the following year, which we've worked out as the $5.97 or F65, going to be divided by, open brackets, the rate of return, which is 4.5%, minus the growth off into the future from year 4. And remember, after year 4, it only grows at 2%. And so I've got my equation there. I've got a share which is getting a 4.5% return. It's expecting to grow off into the future at 2%. It's earning me a dividend of expected dividend in the coming period, like that's the D5 dividend of $5.97, and that gives me a value of $238. I discount that by the 1 plus I to the n, the 1 plus the discount rate in the 4th year, gives me that discount factor, and that gives me a present value of 200. And so altogether, that share is worth $219.89, let's say $220. And so that's my calculation there. This is a fairly involved calculation, so I do recommend that you do the same thing I'm recommending you to do for the others, and that is, by all means, copy the model that I've just put together in Excel. But as well as that, do it on a piece of paper by hand, write out the numbers with a pencil, and calculate using a calculator. And you'll see that you can use either a financial calculator or a scientific calculator to work this out, because there's no fancy financial maths in there. It's all just 1 plus I to the n, either multiplied or divided. And we end up with this number, which is the solution here. So the value of the share, call that P, is equal to $219. Okay, step through what I have done. Okay, I've talked you through the situation. I've showed you how the calculations are worked out period by period, if you like. Think about what's actually happening, in terms of the dividends, and then see how we've translated that into mathematics. After you've done all that, and you're happy with this example, which is really all of this stuff, I'll put a nice little square around that, you can do what's pretty much the tricky end of share valuation. Come back to the slides. What we've been doing is simply evaluating that. It's all good. Read through what the slide tells you, because that's the text. I've already explained that to you in words, but you read it through for yourselves. And then you can work through the examples, and you'll see we've got this D plus 1 up in the top line there. We've got, but anyway, it's stuff that we've all done. So work through the slides now, and you'll find that as we work through, there is a worked example using different data. Now, I specifically want you to use the different data because we've done this in our demonstration with one set of data, so you've seen it done once. Work through the slides, calculate that with your calculator, and now you've done it with a different set of data, which is really good for your learning. And so go through these examples and make sure that you can sort of follow through how you get all these numbers. And if you do all that, you'll find that you'll be really good at your maths. Okay, here's another worked example. Da-de-da. Fantastic. Looks complicated. It's a whole page of algebraic squiggles and stuff. But really, once you understand it, the individual steps are quite simple. But you do have to be a little bit tidy, that you understand what's happening where, because that way you don't use the wrong factors or something silly like that. Okay, preference share value. Hang on, where are we? Yeah, we've done all the maths for that, so it's just a matter of reading through what's going on. Okay, that example. The buy-sell decision. Now, this is a fancy title for which is something really, really simple. Okay, let's go back to our example here. We've worked out that the value of this share at this moment in time, maybe it's a initial share placement, IPO, and you want to work out what to bid. We've worked it out as about $220, $219.89. Would you buy it if the market was snaffling them up at $350 a share? Probably not. We should say, that's too expensive. It's not worth it to me, because I've done my calculations, I've got my best estimates for these things, and for whatever reason, the market is paying too much. They should be, what do we say, $220, and for some crazy reason, people are paying a lot more than that. You wouldn't buy it. On the other hand, if you do your calculations and you say, I'm happy with that, and this is the prospects and everything that I've checked, and looks like their business plan's good, all that stuff, and people couldn't sell them for more than $180, would you buy them? Easy enough. Buy cheap, sell dear. Okay. So in the buying situation, you're going to be better off if you buy them, if you can get them in the practical marketplace for less than the $220, and you're going to sell them if the market suddenly, for some crazy reason, is starting to price them unduly and maybe, in your opinion, crazily high. When you see the market coming in with numbers that are quite different to what your analysis shows, you should at the very least exercise a certain considerable amount of caution and maybe run through your numbers again. You may have missed something, you may have made a calculation error, whatever it is. It's a good idea to at least check, because the market usually is made up of a whole lot of people doing their sums as well as they can, with nice sharp pencils, and so they're not usually that stupid, but they might be, and that's really where you make money. In anything in business, you make money when you're buying when everyone's selling and selling when everyone's buying, largely because the prices in the marketplace are mispriced. When we're talking about the buy-sell decision, you'll notice that we're really making a distinction between the value and the price. And this value-price distinction is really, really important. And it's one of the major confusions in economic thinking, really most commercial financial thinking today. We tend to think that value equals price because we assume that we have a perfect market. The practical reality, and this is where making money in finance is so it works, is that the market is not perfect, never perfect. Economists are really imagining things with that assumption. In finance, we know that the market is not. We accept that fact, and away we go. And so whereas all the economists from Adam Smith onwards have been equating value with price, we say, no. We can work out the value. What the price is in the marketplace is a very different thing. Okay? Value is the usefulness to me, or the usefulness to the owner, the capacity of something to bring happiness to the owner, getting a bit philosophical. The price happens to be the amount of money that the thing will be exchanged for in the marketplace. If the price is higher than the value, you sell. If the price is lower than the value, you buy. Okay, you'll find that these next few slides are really just a recap, and they look at the ways that you compute or consider this equation. Notice here, there's a really interesting thing here. We don't find in our culture very much anymore. Notice this, we're talking about fair price. The fair price is what the perfect market would return if it was perfect, if everyone knew what was going on, because then, in all of the assumptions that economists use, we would actually have price equaling value. That's a fair price. That notion of fairness, by the way, culturally goes back a long way. The Romans, back 2,000 years ago, had a concept of a fair price, and that came down to us as a whole set of thinking around the idea of a just price. Not just fair. Fairness implies justice, fair play, that sort of thing. A just price means an honest price. And going through the history of that is an absolutely fascinating area. You also find it in Islamic thought, that the idea of a just price had a lot of thought going into it, especially around several centuries ago, around the 1200s, for instance, plus or minus 100 years. A lot of Islamic thinkers were giving a lot of thought to what a just price was, and especially the idea that if you charged an unjust price, you are actually stealing. In the West, we want to make money by unfair pricing, by a disjoint between price and value. Okay, it's just useful to be aware of that, because finance is all about getting the advantage off the other bloke, other person in the marketplace. Okay, go through these slides. I'd like you to read these, and that's useful. Share. Now, we've already gone through this when I introduced the idea of growth, and so I'll let you work through these slides. And that leaves us to looking at the question of foreign currency. Foreign currency also opens up a big area. I'll let you read through these slides because it's more of a concept. There's some calculations involved, but at this point, all we have to be is introduced to the concept. We don't have to go through the mathematics of it exhaustively. It's probably a good idea, especially if those of you who are more interested in getting everything you can out of it, to be able to work through the math. So I do recommend that you go through this carefully. Again, depending on whether you want to pass in the subject or a high distinction, I'll leave that to you. The long and short of it is simply this, that in our tending to be global world, except for, well, anyway, in our global world, we tend to be dealing with people coming from different countries where their economies are working in different ways, they're using different currencies, and there's this question of the parity, the relationship between the different currencies. So if I borrow money from someone, let's say in Japan, where the Japanese are used to, let's say, investing and lending with a particular expectation of rates of return, interest rates, and so on, then it may appear that I can get my money either cheaper or more expensively. I'm probably more likely to borrow from Japan than from Nigeria. And I'll let you look at the numbers of those two countries to get an idea of why I say that. Because the yen appears to be far more stable and I can get yen cheaper. However, over time, there's also the question of what happens to my currency compared to those currencies. For instance, if I borrow, $1 million worth of yen today with the expectation of giving them back to their Japanese owner in 12 months' time, and I think this is fantastic because the Japanese investor who's lending it to me is used to only getting, 1% interest rate or rate of return. And I think that's fantastic because here, if I want to borrow money, I've got to pay maybe 3%. So there's this benefit, okay? That's all good, assuming that in 12 months' time, the relationship between Japanese yen and Australian dollars is the same. If the Japanese yen becomes more valuable, which is another way of saying that Australian dollars are becoming less valuable, then when I go to return that $1 million, I'm going to actually have to pay back more yen, or at least put more dollars into the repayment to get the same number of yen. Okay, and that means that this relationship, investing across borders, you've got not just the dynamics that we're looking at here in terms of returns and growth and dividends and so on. We've also got the currency exchange factor as well. And so in these slides, we basically go through some examples here of foreign exchange and how that affects as we cross through these borders, these currency borders. And I'll let you work through those. As I say, we'll consider those as, if you like, an advanced question. The math is exactly the same in that we're always dealing with something that looks like growth or inflation and discounting. So I think that sort of covers everything for today, and I hope you enjoy reading through the chapter and in the textbooks, also going through the slides in detail. And whatever you do, spend a bit of time with your financial calculators or even your scientific calculators for this work, and build up the Excel models and so on, and you'll be really on top of this whole question of share price valuation.